Back in 1907, the US economy was on the brink of catastrophe. It was again going through another banking crisis that was about to destroy the entire country. That's when Wall Street turned to the most powerful men in Wall Street to save the US economy. If it wasn't for JP Morgan, it would have turned into a catastrophe for the US economy. The US government didn't like the fact that one man had so much power over the entire economy. That's when it was decided that the United States needed a central bank. Over 100 of the most influential people in the United States got together in a meeting on Jace Island and decided to create the Fed. It became the most powerful bank in the entire country. I mean, it had the ability to do something that not a single bank in the country back then could do, and that is printing the US dollar. Without it, the United States probably wouldn't be the superpower that it is today because it played the most important role in making the United States such an economic power. However, in 2008, something terrible happened to the US economy that was about to crush the Fed. It wasn't prepared for it. Some people already forgot how terrible the 2008 financial crisis was. I mean, it literally put the entire US economy on the line, since the rest of the world depends on the United States and the dollar for global trade. Saving the US economy literally meant saving the global economy. This is when the most powerful man in the world, back then, the chairman of the Fed, Ben Bernanke, decided to do something that the Fed had never done. You could say that this was the beginning of the end for the United States because this is when the United States got hooked on free money. The Fed lowered the rates from about 5% to literally zero. But guess what? That didn't really help. It didn't really stimulate the economy to grow again. Investors were afraid to spend. The US economy didn't just stop growing. It was literally collapsing. The 2008 financial crisis will go down in history as one of the worst crises in the history of the country. That's why the Fed had to take strong actions. They decided to buy lots of mortgage-backed securities and treasury bonds, which means they put a huge amount of money into the economy. This was a risky move because it could have led to high inflation and made the dollar less valuable. When the economy starts growing again and the trillion-dollar boost from the Fed's action kicks in, they will slowly sell those bonds and take the extra money out of the economy. But just as they started doing this, another crisis hit in 2020. The whole world, including the United States, was in big trouble. Since the US had already faced a big financial crisis in 2008, they knew they had to act quickly to prevent this crisis from dragging on for a long time. Here's how it works. The government sells IOUs called treasury bonds to raise money. The Fed buys these IOUs from the government with cash. For instance, if it's a $1,000 bond with a 5% interest rate, the Fed pays $1,000 upfront and $50 every year. The government can then use this money for things like infrastructure or stimulus checks. This helps prevent an economic collapse and can boost the stock market, as in 2020 and 2021. When investing in stocks, the goal is to see their prices rise because the company is profitable. The stock market boomed when a lot of cheap money flowed into the economy. However, this influx of money obviously leads to inflation, causing the value of existing dollars to drop. There isn't a single example that I can think of when the government suddenly started printing so much cash and started injecting it into the economy, and that did not create massive inflation. If we look back in history, we can see examples of countries that printed too much money and ended up with massive inflation, which ruined their economies. For instance, the Weimar Republic in the 1930s and Zimbabwe in 2006 are good examples of this. Now, you might wonder why the United States didn't face the same fate when it started printing lots of money. Well, it's because the US economy and the US dollar are not like any other. The US dollar is used all over the world for international trade, so the US can basically export some of its inflation to other countries. This means that when the US printed trillions of dollars, it didn't cause as much inflation as you might expect. However, it's important to remember that you can't just print money endlessly without consequences. The Fed had to make a tough choice: save the economy and stop printing money, or keep printing money and let the stock market do well. But what's the point of a booming stock market if the value of your money goes down the drain? That's why the Fed chose to prioritize the value of the US dollar, even if it meant the stock market took a hit and reached a low point in 2022. If you go back to the end of 2021, when we just had rumors that the Fed could possibly hike the rates in the foreseeable future, those rumors alone already destroyed some of the largest companies back then. And when the Fed actually raised the rates at the beginning of 2022, just go back and take a look at what happened to the market. Some of the largest companies literally declared bankruptcy. All of those companies that did not have a strong foundation vanished. And the worst part about it was that we had some of the largest banks in the country that couldn't stand the pressure and had to declare bankruptcy. Everyone at this point was convinced that this was the time to pay the price for all of that cheap money that the Fed printed during the pandemic. The United States has the ability to borrow much more money than any other country on the face of the earth. But sooner or later, it has to pay the price for all of that debt. While everyone was blaming high interest rates for the collapse of the stock market, there was something else that was happening that actually created all of those bankruptcies. Inflation was so bad in the country that the Fed decided that raising rates alone was not enough. It was time to get rid of all of those bonds that the Fed had purchased during the pandemic. This was literally the best way to actually decrease the number of dollars in the economy by letting all of those bonds mature. In other words, the Fed started selling almost $100 billion worth of these bonds every single month, which was one of the main reasons behind all of those bankruptcies. Even if the Fed sells those bonds at that pace, it would still take them more than 8 years to get rid of all of them. Here's why. When the economy starts going downhill and people are losing their jobs, they have less money to spend. This means less money going to businesses, which leads to lower profits for those companies. When companies make less money, their stock prices in the stock market tend to go down. So, in simple terms, the Fed is trying to reduce inflation without causing a recession. Now, remember that the economy and the stock market are not exactly the same thing, but when the economy goes into a recession, it means less money for businesses, and that often results in a stock market crash. Recently, Jay Powell, the head of the Federal Reserve, mentioned that they won't be raising interest rates again for a while. This is good news for companies because higher interest rates make it more expensive for them to borrow money, which means they have less money to invest in new projects and ultimately make profits. The best part of this press conference was when Jay Powell hinted that the Federal Reserve might start lowering interest rates by 2024. Now, don't expect them to drop rates all the way to 0% like they did in 2020. That's not happening in the next 2 or 3 years, maybe even longer. But the idea of rates going down is good news for businesses. It means they can borrow money more affordably, which should help the stock market grow faster. In 2023, the stock market did pretty well. If you look at the numbers, the S&P 500 index is already back to where it was before the pandemic hit. Take Apple, for example, it's back to being valued at $3 trillion, especially when you compare the United States to other parts of the world. China is facing difficulties, Europe is dealing with Russia, and the Middle East has its own problems, while the United States seems to be doing better. But don't be too complacent. The stock market could still have some problems ahead. It might seem like everything is going well, but if you look at the S&P 500, you'll see that just 7 companies make up over 25% of its total value. The S&P 500 represents the 500 biggest companies in the US, which is a big part of the US economy. When such a small number of companies have such a big influence, it can be a cause for concern. Sure, these big companies like Tesla, Apple, Amazon, and Google are doing really well. They have tons of money in their bank accounts. But when you look at the other companies in the S&P 500, many of them are struggling. If the Fed starts selling all the bonds it bought during the pandemic and reduces its balance sheet, smaller companies might start going out of business one by one. The Fed still has almost $8 trillion worth of these bonds to sell. We're not sure how long it will take them to do it, but they need to do it in the next few years or maybe the next decade. Why? Because if another crisis comes along and the Fed already has a huge balance sheet, they won't be able to use their usual tool of printing more money to fix the problem. So, they have to start selling those bonds, even if it means some companies might suffer. Now, how many companies will survive this? We can't say for sure, but there will probably be more companies going bankrupt in the future. So, while we had a market crash in 2022, that's not the only price we'll have to pay. The total cost of printing so much money is around $8 trillion right now, and we'll be dealing with it over the next decade or so. The best case scenario right now is this. The Fed gradually lowers interest rates over the next 2 or 3 years to about 3% or 2.5% without causing big inflation. At the same time, they'll work on reducing their balance sheet to a more manageable level over the next few years. So, will the market crash again in 2024 or 2025? It really depends on how the Fed is going to manage this crisis. Thanks for watching. Subscribe for more weekly videos. Leave a comment below. Take care.